Well, good afternoon, everyone. We are going to get started. It's almost 1 p.m. Everyone is on muted mode. We are going to be using the chat feature during the session. First, we have a great host today, a great guest today with us, Kelsey from STR. And then we are going to open the session with questions and answers using the chat feature. Kelsey is a business development executive with STR, and we are very thankful to STR with all the data that they have provided since this pandemic really started. The data is very depressing, so just put your seat belts and be ready. I think we are at the bottom of the verse. I hope so. I hope sunrise will be on the horizon at some point, but the reality is 8 out of 10 rooms in the US at least are not occupied. And the numbers are rather alarming. So thank you for being here, Kelsey, and thanks to STR for this brilliant research. The floor is yours, and we are looking forward to seeing some more data and hopefully some more hope.
Thanks, Ezra, and thank you so much for having me today. And yeah, like you said, the numbers are not great. Going to try to keep a positive attitude about it because, again, this will not last forever. This is what we're dealing with right now, but hope is on the horizon. It's just a matter of time for us to get there. So just really diving in to the US data. So this is where we saw March. Really negative numbers. Our RevPAR was down 51.9% compared to March of 2019. Again, that's the revenue per available room. Our rates were down, but not nearly as high of a decline as RevPAR and occupancy. And we're really seeing that because the high-end properties are not selling rooms, but those lower-end economy, mid-scale properties are. And so this rate makes a lot more sense for those properties when we're taking out those luxury and upper upscale hotels. Occupancy is down 42.3%, and that's really, again, just because that room demand is down. We are still seeing new properties open and being built, which is why we're seeing that room supply continue to increase. And this will be something that we want to watch for the next few months and really even the next year and a half as the pipeline has not dropped a whole lot. Things have just moved down in terms of when the projection open dates are happening, but they are still in the pipeline. Looking at the March numbers was bad, but looking at it compared to the last 6 months is almost worse. So seeing that we did start to have really a natural slowdown in 2019 and then just get hit with this on top of that, it's really jarring results. So for Q1, we're down over 19%. And that's really being brought on from the declines in just that March data with that 51% RevPAR decline. Looking at the historical set even farther than 2014, we're seeing that this is the lowest month that we've ever had on record in terms of RevPAR growth year over year. It's really twice as bad as what we saw after 9/11 and after the housing crisis. We're hoping that the recovery will not take as long, but that's still to be seen in terms of when stay-at-home restrictions are expiring, when travel bans are lifted. So this is something to keep an eye out, is how bad this 1 month has really truly been. So switching from March and Q1 to current data, so the week ending in April 18th, we saw RevPAR down 79.4%. So Ezra was saying that hopefully we haven't seen the worst. Really, I think this has to be it, right? 80% down. It is going to be significant. April data is going to be significantly worse than even March was. And we saw March at that 50% decline. As of April 22nd, of the rooms that STR tracks, we had about 14.9% rooms closed. For the US, our segmentation data, there is absolutely no demand whatsoever in transient or group. Group surprisingly is less down than transient, 5 percentage points, but ADR is down about the same, and then RevPAR is down over 90% as well for both transient and group bookings, ending in April 18th. So I always feel bad because some presentations Canada is last, so I wanted to put them here in the middle because we all love Canada as well. So really looking at Canada as a whole, I put the dollars in Canadian dollars, but they've seen really the same declines that we have in terms of occupancy, demand, and RevPAR. Rooms revenue is also down 50%. Their ADR is actually a little bit higher than ours in terms of they weren't impacted as much for rate. So a lot of the same rooms are being sold. So that's the one good news for Canada, is that their rates are really staying the same. So for Q1, that was March that we just looked at, and it really impacts the Q1 total. So January, February, they were positive, but with those negative 40%, negative 50%, it's really brought everything down for the start of 2020. Again, for the week ending April 18th, we did see RevPAR down 85%. So this is notably larger than the US impact. So maybe Canada was just a little bit slower to feel the impact than the US. So that'll be something that we are going to keep an eye out on for April data as well. So looking at all US submarkets, we're really seeing declines. So this is going to be how many markets are in RevPAR declines, and right now all of them are. So when you think about it, February, January was about 40% of all 645 submarkets were in decline. Now it's literally all of them, and on a 12-month moving average, it's nearly 80%, and I would not be surprised to see that increase after April data is done as well. For the top 25 markets, it's the same everywhere. Everywhere's bad. No one's doing particularly well. So this is Q1. I mean, 71.9% sounds awesome for Oahu Island, but when you think about it compared to Q1 last year, that is down still 10%. Dallas is down 17.2% with an occupancy of 75.5%. And then San Francisco, even though they are more near the middle in terms of actual occupancy for all top 25 markets, they're actually they had the largest decline in RevPAR year over year for Q1 at almost 30% lower. When we are looking at actual occupancy, and this is going to be for the week ending April 18th, we have some winners here. So Chattanooga, they actually saw over 50% of their rooms being sold for that week, whereas the Florida Keys only saw 7.6% occupancy for the week ending April 18th. And then Hawaii, they are going to be the lowest as they're trying to get people to stop coming and are even paying to send people back who are not quarantining. So I find that very interesting and kind of a fun new way of DMOs, a new, we keep talking about like, what are the new roles of DMOs, and the fact that Hawaii is actually planning and paying for people to leave who are not following the laws. I just find that very, very interesting. Looking at all 50 states plus Washington, D.C. For Q1 demand, we're really seeing the biggest declines in Washington, D.C., Nevada, California, New York. So the areas that have been the hardest hit, and then the areas where basically like the whole state shuts down, like Nevada, the Strip completely shut down. So that's going to be a huge factor in the decline there. Two states that had the least impact were actually Maine and Montana. Again, we're seeing that those interstate properties are not being hit as hard. So that's really why we're seeing places like Montana, Wyoming, they've got all of those interstates that run cross country. And so a lot of people who are still needing to deliver goods and the truck drivers, those are some states where we're still seeing some demand. And then by state, this is where we see some of the occupancy differences here. Again, Hawaii at the bottom with 8.3% occupancy for the week of April 18th. Alaska actually had the highest at 31.9% occupancy. Delaware was second with 30.3%. So even though these guys were hit harder than states like Maine and Montana, they actually have a higher occupancy right now in April. So I thought it would be interesting to look at kind of some West Coast, East Coast markets and see when they really started to get an impact in occupancy. So we'll look at Washington and California first, and then go over to New York and DC. So here we're really seeing that occupancy really plummets the week of March 14th, when it drops from 55% to 39.5%. It was actually a little bit later than I had thought it would be, but then it's been staying pretty consistent since the week of March 12th. It stayed around that 20 to 25% occupancy range. Looking at California, it took them even just a week longer to really get that steep occupancy decline. So that didn't happen really until the week of March 21st. When it went from 53% to 28%. And then they too have stayed pretty flat in that 25 to 20% range. You do see that it's ticked up just a little bit in the last week we have data for. And now for the East Coast, it's a lot different of a picture. So when we look at California, they got hit in week 12 is what we're calling it. So week 12 of the year, so March 21st. New York also got hit the hardest in week 12, but the decline was much, much steeper than what we had seen for the West Coast states. So it went from 72% occupancy to less than 50, all the way down to 16.9% occupancy. But on the interesting side is that after March 28th, it has really picked up. Again, that's got to be due to the out-of-town recovery workers and healthcare workers, people not staying in their apartments, but staying in hotels because they don't want to get their family members sick. That's really why we're seeing those increases in New York, is really because of New York City and the rescue and recovery workers that are coming in and flooding the city. Washington, D.C. had even a harder and steeper decline. So this dropped almost like 65 percentage points in a matter of 2 weeks in terms of occupancy. So it went from 72% down to under 50, and then down to under 10. And where we've seen the rest staying in that 20 to 25% occupancy range, they really have bottomed out at under 10%, and have been staying that way for about the past 5 to 6 weeks. So we looked at states for the US, and then we'll look at provinces for Canada. So looking at Q1 demand over 2019, we see that it's really being, so the Canadian average is really being brought down by New Brunswick, Alberta, and Quebec. whereas Newfoundland and Labrador, they were doing better. Their impact was about -12 compared to New Brunswick's -21% growth year over year. Again, this is just for Q1, so when we add in March data, we can really see a huge difference. So those teal numbers are the same that we just saw, and they looked bad, and now we add in March data and it is even worse. So Quebec is down over 50% year over year in demand. British Columbia is down over 40%. Really, almost everyone is down over 40% except for Prince Edward Island, and then again, Newfoundland and Labrador. Quebec City is definitely the one that has been hit the hardest in terms of demand loss year over year. So looking at not just the province level, but looking at major metro areas, again, wanted to kind of see who were the highest occupancy rates compared to the lowest. In London, Ontario had the highest occupancy at 25.2% for the week ending April 18th, and Calgary had the lowest at 8%. And we see that Montreal and Quebec City, they both also fall into that low category, which also speaks to they are going to continue to see negative demand numbers for April, even worse than what we just saw with that -50% for March. And then percent change. So again, terrible, terrible news for the province of Quebec. We see that there's -93% for the week of April 18th in Quebec City, -90% for Montreal. April is going to be a much worse month than even March was. On the same side, we saw that London had the highest occupancy, but they also had the least amount of decline for growth, even at that 46.3%. I never thought saying a decline of 43% or 46% would be a good thing, but these are the times. So London, Ontario has actually done the best for the major metros in terms of not getting the occupancy impact that some other markets have. Then looking just briefly at the last two downturns, really just wanted to show this to see how long the previous have taken to get back to that 0% RevPAR growth, so getting back out of the negative. This is not great news. So 9/11, it took about 3 years to get back to RevPAR 0% change. And then after the housing crisis, it took about 5 years. Not great news. It really depends on if we are more in a long-term economic recession or if this really is just a black swan event that it's just a big shock to the system, a big shock to travel specifically, which, like the Lehman Brothers was the whole economy. 9/11 was a lot more just travel. So depending on how long these stay-at-home orders last, if the virus comes back, really will be a major factor in how we see our recovery and how long that will take. So like I said earlier, our interstate properties are not getting hit as hard, and this can be seen even with those other two downturns, that rural areas, they came back much faster. I mean, after 9/11, it didn't even take a whole year for RevPAR to get back to that 0% change, getting out of the negative. And after the housing crisis, it took about 6 to 7 months faster for rural properties, I cannot say that word, but for more rural properties to get back to that 0% RevPAR change, getting out of the negative, than it did for more urban areas. So just keep that in mind too if you are a major metro, to expect to take a little bit longer to come back than some of your more rural neighbors. Again, this is just showing more proof, really, that interstate properties are not hit as hard. That is where all of our economy properties are. That's where we're seeing most of the rooms being sold, whereas resort properties and our urban metro properties are having the largest impact and seeing those declines even more. So just finishing my slides before we get to the questions, I wanted to talk about where we're expecting to go. So all of these numbers, so these numbers are for when the impact started to now. So that's why China's a little bit farther out to the right, because they've had the pandemic for longer. So we're seeing that China has started to recover in terms of occupancy. That has leveled out a little bit in the last couple of weeks at around 30% occupancy, but 30% is much better than 10%. Really, you think about that week over week, that's a 200% increase. So definitely good news there. And good news for the US is that we're not hit as hard. You can see that our occupancy for the country never got below, or has not yet, and hopefully will not get below that 20%. Whereas Europe got under 10%, China got right at 10% just for a week. But Europe's really stagnating and staying in that under 10% area. So some good news for us, the impact's not as bad, and we are starting to already see a peak there. Hopefully that will continue. So just proof that it's not as bad as it could be. We did this forecast March 30th, and we plan to work with Tourism Economics and provide a new forecast in the next week or two. So just be on the lookout for that, because we will post that on str.com and hotelnewsnow.com. But this is where we see it as of March 30th. So these are going to be year-end numbers. So that supply number that we're seeing at negative 14.9, that's not where we see December itself. We do expect hotels to come back. We expect new hotels to open. This is just going to be the year total, because again, we have so many hotels that are closed right now across the country. Demand, we do expect to be down 50% for the year, which will then, of course, bring occupancy down. ADR will be down as well, and then RevPAR down at over 50%. When we're looking at 2021 numbers in terms of growth, this is again going to be growth from 2020, not growth from where we are right now. So we're going to see an increase in supply from where we are right now, but we are not going to see an increase in some of the other KPIs. So like ADR will still be down from where we are right now. Just some things to keep in mind. So occupancy, we do expect to come back 57.3% from 2020 year end. Demand, we really expect to come back hard with an 81% increase over this year's end. So what does that mean? So looking at 2019, we see that occupancy ended at 66% for the country, ADR a little over 130, and RevPAR at $87. We're not expecting to see our RevPAR come back to 2019 levels for more than the next year and a half to 2 years. We do expect it to take at least 3 years as of right now to come back to 2019 levels. When we look at it, our 2021 forecast is not even at 2013 levels in terms of occupancy. So we don't expect occupancy to come back because we are still building hotels and demand is still going to be slower at recovery. Even with that 80% growth for 2021, it still will not quite hit 2019 or 2019 levels in the next, what is that, 21 months. ADR will be above 2013 levels, so that's good, but it will still be about $15 below our 2019 levels. So it's really just don't expect us to be back at where we were at the year end for 2019 for quite a while. We do expect things to turn around and come back towards positive. It's just not going to get there soon. And then looking at how we expect the US compared to other markets, we do see that we have a RevPAR percent change for 2020. Again, this was forecasted in March, so this might change when we do our update, but we do expect the US to be hit the hardest in terms of RevPAR, but our ADR is going to stay in range with everyone else. This really just, again, depends on how long all of these stay-at-home orders last and if there's going to be a full country reopening, if we're going to let travelers in from international markets, where we're not seeing quite as many travel bans for other areas as we are for the US. And like I said, just keep an eye out on str.com and hotelnewsnow.com because we'll be posting all of our press releases here. So any new interesting data tidbits will be here. Our new forecast will be uploaded on this site in the next week or two. There's lots of great videos. So everyone loves Jan. So Jan's been doing weekly videos that we've posted as well. Even though he's not doing the webinars right now, he is still doing some videos. So make sure to check those out. And then for universities, we do have our Share Center. So we're still doing online training. And we do have webinars being posted and updated as well. If you would like one for you, feel free to reach out to the Share Center and they'd be happy to help. So I will turn it over to Ezra for the Q&A. Thank you for having me.
Thank you, Kelsey. Are you guys going to update the forecast again or just see how things move?
Yeah, so we'll update it in the next week or two, and then after April data comes out, we'll kind of see what that looks like, and we might update it again. If it's still just, we think it's going to be bad and we think it's going to stay around the same amount of bad, then we'll probably just wait until the next quarter to update it. Thank you.
The Chattanooga data was very interesting in terms of the 57%, and McCready had a question about it. First, the remark was the occupancy was likely to be influenced by the tornado on April 12th. But furthermore, for the first few weeks, I thought group was done more than transient. So I was wondering when and why that flipped, what groups are actualizing?
Yeah, so it seems to be more like negotiated rates almost. So not quite contract, but more of the group business in terms of like, we have this amount of room blocks for healthcare workers. We have this room block for maybe homeless people. So it's kind of that type of group business. It's not traditional groups.
And that's probably what New York City is seeing as well, and some of the urban markets.
Yeah.
That's a good point. We have both Canadian and European members on the call as well. Simon from Canada said, in Quebec City, we are lucky to have the 5% occupancy, and that was the lowest. It's the biggest hit.
Right.
And Mike from Europe has said, listening from Europe, I wonder whether the government restricted domestic travel. Are hotels allowed to host tourists? Example, in Austria, all hotels had to close and are still closed until mid-May, meaning US and Canadian government. Anything you are seeing from that regulatory environment and some of the restrictions with the close of business in Canada, for instance, and some of the restrictions in Europe? What are the, some of the nuances from different markets?
Yeah, so we, at least in the US as a whole, have not had those restrictions placed. So people are still traveling if they want to. It's really certain markets and cities and states that have more of those restrictions. Just talking to a couple of friends over the last few weeks and hearing stories about people they know who've had the police called on them for traveling. I don't know who you are, you shouldn't be here. So there really aren't legislative issues with it. It's more just we're expected to stay home. So that does make a lot of sense why the European numbers are so low, is if they literally have to be closed, whereas we're still, it's not mandatory to close. Some brands are saying like, yes, hotels in these cities, you're going to be closed. Some it's just the GM gets to decide. And then others are open and willing to host anyone who wants to. And then of course with those healthcare workers, and then working with local governments on like basically sheltering people without homes.
Yeah, I think it will be interesting to see what with these soft openings, how things are going to shift, especially some of the southern states like Georgia, Texas. I'm really curious about those patterns. And even just looking at the group and transient, Chris mentioned about the Easter shift. When we are looking at that clip, it impacted. So that was a really good point, Chris. Thank you. Nandi had a point from China and South Korea. She's saying comparing US to China may not be apples to apples, considering recovery and tracking in China has been a different process than US. Better would be South Korea. Any thoughts on that? Do you have any information about the South Korean hotel market?
Yeah, so we have it. I did not run any information on that, but I can certainly make a note to find that. We've been using China just because, I mean, it's been in the news and that's what everyone else has been tracking. So we have great sample and participation in China. So our data has been really robust there. And that's kind of why we tracked from the start of the pandemic to now, not really now. Like how they are doing right now compared to how we're doing right now. It's really how they were doing 3-4 weeks ago compared to how we are now.
Yeah, but South Korea, Singapore, they seem to be doing better in this kind of a market. Of course, better became relative, just like you said. We are looking at even a minus 40%. Oh gosh, it's not as bad. Mike, just staying on the international topic, Mike put a remark here regarding Austria, and he was saying that they're guessing about 15% of all hospitality businesses in Austria will fail, those who already had financial problems before a lockdown. And in relation to this, I'm jumping to Tracy and Logan's comment. US has a huge domestic tourism market, and just like the numbers we have seen in the drops, can you imagine small islands, for example, Jamaica, who depends heavily on international tourists? Kelsey, any assumptions you are making internally, because this is going to impact supply, this is going to impact 2020 business, and we are looking at recovery not even happening in 2021, probably on average. What is STR looking at this trend line? Is it going to wipe up some of the supply? What are some of immediate observations?
Yeah, so it will definitely wipe out some supply, especially on the lower end and those independently owned properties. We're not expecting to see huge shifts in branded properties in terms of closing permanently. And like I said, we're still seeing our pipeline. It's at the highest level that we've seen in years. So we're still expecting to see a lot of new hotels opening. Again, that can always our attrition rates have stayed the same for the last few years, but that of course could change with all of this, and depending on how long it takes to see some of that demand come back, because that's really going to be the biggest driver, of course, is the demand. But we're still expecting to see 2-3% supply increases for the US.
For 2020?
Yes, yeah. And continuing into 2021. So we're expecting a lot of the drive markets to come back again, those less urban areas. So it really is domestic travel that's going to come back first, is what we're expecting. So those markets that are heavy on the international travel, they might struggle for a little bit longer.
Yeah. John also mentioned about this seems to be an assumption of net new supply. Won't some hotels fail under these conditions? You answered this question some. I'm curious what that percentage is going to look like, even though we're going to see new supply coming in 2020, 2021, that was already planned. But hopefully we won't see much diminishment from a supply perspective.
Yeah,
so
and we haven't seen
your numbers.
Right, and we haven't seen mass closures on the independent and economy side in several years. They've still been able to make money, and I think if anything, we'll finally start to see some of those properties close that in a normal cycle would have closed 2-3 years ago, but they've just been able to make enough money to survive. I think those would be the properties that would close first, but then again, that net new, we're expecting to still surpass any closures.
Yeah. And Simon said only 21 hotels are open right now where he is at, and just like the cash crunch, how things are going to come together, and probably we are going to see more consolidation.
Mm-hmm. Oh, and that's been a huge thing already is Marriott and Starwood and those kinds of mergers, and I think that's a very good point that it's just going to continue happening.
Wendy has a question, and thank you guys for these wonderful questions. Are you including public use of hotels for shelters in your occupancy? I thought I heard that this use would not be including.
Yeah, so it just depends. So if the hotel is so if like the city or government has not bought out the property and is just like taking it over, then rooms that are being given to these other groups where the hotel's still open for other guests, then yes, those are going to be put into our occupancy. If they are like truly being sold per night, there do have some like San Francisco, San Diego, where like an actual hotel has just been taken over, and so those numbers are not going to be put into our ADR and occupancy.
And going back to that ADR and even RevPAR, just to confirm, this isn't from Rhonda, are you predicting that room rates will not come back to 2019 levels for 3 years?
Yes, so it's really what we're expecting. Definitely, at least not for the next 24 months, but historically, I mean, even looking at 9/11, it took 3 years to get back to rates that were before pre-9/11. So I think 3 years is really an optimistic look.
And Kelsey, are you also expecting that same level of pattern for occupancy? That was also a question from Rhonda.
Occupancy is a little bit different. So that really it really truly depends on when we're going to lift all of these restrictions, how long this lasts. If it does turn into more of an full economy issue instead of just a travel issue, because when we looked at the Lehman Brothers and things, it took, in the housing crisis, it took 5 full years for RevPAR to get back. So that's the combination of occupancy and ADR. So really, if we get back to business sooner than later, then I don't think occupancy will take as long to come back. But if this does extend for the next 6-7 months until a vaccine comes out, then it really could take longer.
Yeah.
Because as more people are out of work, then they don't have the funds to travel even when they're allowed to.
Both Simon and Tammy talked about how hotels are being utilized, for instance, from Simon's perspective, because there have been no health problems in the area. It's not really being used for housing healthcare workers, whereas Tammy from Georgia is saying that hotels are getting primarily first responders, including nurses, doctors, and National Guard. And I think there's a really good positive story here from a community sentiment perspective. Simon asked a question about how many hotels have reported confirmed COVID cases with their staff or clients. And I think this goes back to safety, some of the cleaning issues, sanitation, and that trust factor. Are you seeing anything? I mean, both Marriott and Hilton announced some of their cleaning procedures. Are you seeing anything that's state of the art that's going to build quick confidence and trust with consumers? Anything that's in the background with SDR discussions?
Not really. So not so much beyond just people want to know what hotels are doing. And we've seen that with the destination analysts and Longwood surveys and webinars, that people really just want to know that they're being taken care of. So we haven't really heard of anything new and exciting in terms of cleaning and sanitizing, but that it is really important for travelers to feel comfortable in knowing what's going on before they get back out there.
Yeah, and it will be, again, back to Simon's point, it will be interesting to see what the required actions will be. Are they going to close the hotel, clean it thoroughly, quarantine staff? Are there any case studies or anything that you have seen?
Not that I know of, and I think it's interesting too, because nowhere publicly has there been press releases saying like this hotel is closed specifically.
It's a PR nightmare.
Yeah, right, exactly. So no one wants to come out and say that, because then they don't want to have to beg people to come back and like really say, no, I swear we cleaned it, we sanitized it. So I think they're just
such a delicate
board, because they don't want the fear for people to not come back to a hotel because someone was sick there.
And Lauren asked a question about regarding, Kelsey, to you. What have you heard about health regulations that hotel rooms have to stay closed for 1 to 2 days after being occupied? Any conversations in the background for sanitation and cleanliness?
Yeah, so not like that I've been a part of. I know Hotel News Now, so we do have like that media side of us. They've been doing a lot of interviews with GMs, and that would be a really good source. Something that I'm not 100% sure on, but I can at least send them to a place that might have some resources.
Yeah, I'm really curious about these cleaning procedures. I saw some videos online about China. They had these ultraviolet robots, and the robots were like literally walking in a hotel and hospitals. And apparently when it touches the virus, it cannot grow as fast, and it eliminates it somehow. And it has sensors. So when a human is close by, it stops, the lights turn off. So perhaps technology like that will be things that we see in a common perspective. But Lauren, I heard this closure of rooms for a day or two. I think just different trials that we are going to see from a small business or corporate level in regards to ensuring trust and the sanitation and health procedures. David also had a question. With some hotels closed and others operating at minimal staffing levels, have you heard about increased vandalism levels?
No, I have not. And I think that's also part of the stay-at-home orders, that people are just out less too. I'm sure it's happens. I mean, obviously criminals don't follow all the rules, but I haven't heard of specifically like that's been a huge problem for properties. Staff members are still usually going into the hotels, so security members are still allowed to work with all of the stay-at-home orders. So I don't really expect that to be a huge issue, but again, I'm sure it's happened here and there.
There was another question regarding type of properties. Do you expect motels versus hotels recovering faster What are the nuances that you are seeing amongst different properties? And you mentioned that a little bit, but anything specific? Right now, luxury is not doing so well. So what are we going to anticipate in the near term?
Yeah, so I definitely think that the lower end properties, so mid-scale economy properties, some of those being motels and kind of interstate roadside properties are going to recover the fastest. One, because they weren't hit, and then two, again, because we just keep hearing over and over again, the domestic drive market is going to be the first thing to come back, and that's a lot of times where those travelers stay, is on the way to visit a family member or halfway between their home and the beach. So and that's really historically what we've seen come back first anyways. And then, yeah, those luxury and upper upscale properties are really banking on group business, and we expect that to come back last. So does make a lot of sense for them to take a little bit longer to recover.
Yeah, I think there's a lot of opportunity for rural communities and for tourism development perspective. People will want to be in safe and secure and less crowded places. The great American road trips coming back, I think that's really exciting. Going back to, I want to move into ADR, and Nande brought a question regarding ADR. After every travel-related crisis, hotels discount rates to encourage travel, to bring demand up. If hotels band together to minimize discounting, recovery in room rate and ADR can be better. I mean, just going back to the Lehman Brothers, the financial crisis, it was racing to the bottom. What are your expectations for ADR? I know you shared the forecasts, but what is your instinct? What are you anticipating?
Yeah, so for this, it's not, as at least right now, the rates haven't been dropping to drive demand. They've just been dropping because, again, the types of properties that are selling rooms, that's just what their normal rates are. And I think that's part of what our forecast is too, is that, again, we're expecting those lower end properties to recover faster. So they'll have a higher occupancy, which means the rate will really be driven. The average rate for the country will be driven by those hotels and not so much the upper end properties. I can't say anything at all about banding together. That would get me in a lot of trouble. But we don't expect the ADR if properties are paying attention to our forecasting and to what other hotels are doing. We don't really expect the ADR to drop as much, because if this is just a 3, 4, 5 month thing and then everyone gets back to normal, then that demand, like forecast, is expected to come back 80%. So we don't think people would want to drop demand as high, historically at least. Can't say
I saw
sure.
some interesting stories from Hong Kong as the businesses have been open now for a while. They were saying that even a cup of coffee is cheaper than what it used to be. I couldn't believe it. And they were discussing about the possibility of deflation from a tourism perspective. So I think that's something that everyone is cautious about. We don't want the pricing to go to the bottom. It's going to impact the industry, and it will take longer to come back.
And I can see that if people are still fearful, so even after the bans get lifted and people are still fearful because either hotels haven't been giving their cleaning like procedures, or if cases continue to rise, then I can see maybe then why hotels would change their rates to try to get people out of their homes as a driver. But I think if everyone comes back, then I just don't know why they would lower rates. But that's a really interesting point, that coffee is even cheaper.
I know, I couldn't believe it. Simon also said there should be a plan or procedure for even like 100,000 each. I guess he's referring to boosting that financial bottom line for the business, for the cash crunch. Are you guys seeing any efforts, whether it's the franchisor perspective, corporate, or hotels taking advantage of these CARES Act programs, PPP, or some other initiatives with grants? How are hotels really responding to this with this additional programs, or they're just trying to get by with the storm? I assume they're very proactive.
Yeah. So especially those independent hotels, and I mean, with U.S. Travel and like AHLA really fighting for hoteliers, then they're definitely taking advantage of some of the programs. I don't know about all of the loans programs, because pretty sure we would hear if like Hilton and Hyatt and Marriott got millions of dollars, since we're hearing about the Lakers and everyone else. But definitely the independent, smaller properties are taking advantage, as they rightfully should. Because yeah, it's not been great for anyone in the industry. So I don't know if anyone's negatively taken advantage, because again, I think we would all know about it by now.
And Kelsey, another question. I've been asking this to every guest that we had. Expectations about what is going to come back first. Is it leisure or business? Everyone has a different opinion, so I'm just curious about your opinion.
So I think it'll be more business, not group, but business travel. Just again, my opinion, because I mean, we're already talking about, okay, well, what conferences do we need to go to? What's still like happening? What's on the books? Who do we need to go see and talk to? So I definitely think business travel will resume first, because it's like needed and necessary, and there's meetings that have been pushed off and conversations that other companies that I'm sure have to be having, but would like to have in person instead. And then I think would be followed by the leisure, and then finally the group business. I think that'll be the one that takes the longest to come back.
Perfect. Charlie also had a question. I hope he's still online. He was asking about recovery points that you were making and the timeline. Can you go back and repeat that again? I think everyone is interested again, like looking at that 2-year rebound to get back to the previous year. I think that's such a key data point.
Yeah, so I mean, just looking at like 9/11, so if we are more of just a travel only is really impacted, people start feeling comfortable traveling again, because really there was still a fear with the 9/11, like there's a fear right now. So if this is just a fear thing and trying to be safe, then I think it will take less time to get back to that zero growth. If this takes longer and it has a more economic impact overall, where people have long-term unemployment, they have depleted all of their savings, layoffs happen, then obviously it's going to have a much bigger impact, and it won't be just, I feel safe coming back to travel now. It's, I can't afford it. My company has banned travel that's unnecessary. Then it will definitely take much longer. So that's really one of the things that's still to be seen. But with our forecasts right now, this is kind of what we're looking at. So we're not expecting to even get to 2013 occupancy rates for at least another 24 months. And I mean, you can see here the end of 2021, we're still not even there. So we do really expect it to be more of that 3-year range. ADR, seeing it 117 2 years from now. And again, these are going to be the year averages. So we'll see higher rates and higher occupancies in the summer months, as long as things get back on track. But for the average for the year, we're really not going to see 2019 numbers for several more years. Which is crazy to think that this impact has only been 2 months, 2.5 months for the US, and it's really going to have a long-term impact on travel for the next several years.
Yeah, I mean, all the data points really go back to that March 21 date. And if we are looking at unemployment claims, any number, like that's where occupancy rates, everything started to fall down there. I think your data is going to be very valuable. The GDP numbers came out today. We are looking at almost 5% decline, and how that rebound is going to take place. I think the most disappointing or the scary part is we were all expecting a quick recovery because it was happening fast. It will rebound faster. But it looks like we are looking at 2022, where things may be back to that $87 RevPAR or ADR. John is asking about your forecast, and I think I just have to restate that I think forecast is such a funny concept right now because it's so hard to make a forecast. Numbers are changing on a daily basis. It's the day and age of the fast and speed data. So John is referring to, do your forecast assume more COVID waves? So if we are going to have another rebound of these illnesses, let's say back in the fall, that was an estimate that came out here from UVA. Are we going to see any assumption based on that if we have another wave?
So this does not include another wave. So that would be an even more dire situation. So this is really just with us expecting the declines to continue for the next few months. So again, this was as of March. So we had our March data, not even taking into consideration the negative 50, 60, 70, 80% that we've been seeing in April. And then we expect a lot of hotels are staying closed. Like they've told us they will continue to stay closed until June 1st. So we don't expect May to get any better either. That might be the start of when things come back, but it's definitely still going to be double-digit negatives for all of our KPIs. And just with that next few months, this is what we're seeing. So yeah, I can only imagine what it will look like if it does come back.
Yeah, a forecast is such a difficult concept right now. And anytime I look at data like this, I just look at from a risk factor, how the risk is big or small and how we should be prepared. But I'm so glad to hear that you will be doing more forecasts and keep the industry informed. This research has been these numbers have been phenomenal and it's available to everyone. The China numbers are interesting, even though they are not as relevant, but it brings up the hope in us. The business is gonna come back slowly, and I see trust and the DMO's role as the most important element that's gonna play a factor in future. Just bringing that community outreach, bringing businesses together and taking that message out to travelers. I think tourism is gonna even a bigger role moving forward. So Kelsey, before we close up, what are the top three? Well, Wendy just had a question, so before I move, she said, I would think much of the increase in leisure travel this summer will depend on opening of activities and attractions, theme parks, national parks, sport events. Why travel to if the local assets are not limited, right?
Yeah, exactly. Yeah, I mean that's a major factor.
Irish Carol had the same question as well. So before we close up, Kelsey, what are the top three trends that you see from a hotel sector perspective that you want to give our audience to? Three trends.
Yeah, so major metros are being hit significantly harder than more rural areas. Even those tertiary markets are not getting hit as hard. Again, that goes to the interstate properties, and the economy and mid-scale hotels are seeing the most occupancy. They are able to house first responders, healthcare workers, truck drivers, so people who are still having to work. They are staying in those more economical price ranged hotels as everyone is struggling right now. That is not a surprise. And then we do expect to see these declines continue for at least the next few months, if not longer. Again, yeah, back to Wendy's point, depending on when things reopen in those like we have to have tourism drivers for tourism to actually rebound. So just having a hotel open isn't going to make people travel. It's when they can actually go and enjoy the destinations that they'll come back. So I think those are really, my 3 key points.
To the point. And one last technical question from Irish. In April, will you be able to remove the closed properties from the data, or is it just looking at everything?
Yeah, that's a really good question. So if we didn't receive any data from hotels that normally participate, if we didn't receive any data for April, then we will go ahead and close them and then retroactively like take their data out of April. So that will definitely skew and change some of those occupancy numbers in markets that have a bunch of properties that are closed. But the key is that they didn't tell us they were closed, because if we know that they're closed, they're already being taken out. So it's just, there are a few here and there that, and they're mostly independent properties, because we're getting the data feeds from the brands.
Thank you, Kelsey, and thank you for making that clarification. It's so good to know. Thank you, everyone, for your time. STR is also going to be with us during Marketing Outlook, and I hope we'll all be together then. But have a wonderful day today. Stay well and healthy, and we look forward to seeing you next week. Take care. Thank you, Kelsey.
Thank you.